Good morning. Welcome to the room. Hey, Steve. Nice to see you. Guys, gonna be a good day. I'm excited about today. I'm excited about every day, though. It's pretty cool being me. I don't wake up dreading ever. I love what I do. I love looking at charts. I love finding patterns. Living a pretty charmed life, guys. So let's check news because it's kind of a big deal today. Um, Today is Wednesday, April 9th. And the first thing, my morning routine, guys, every morning, is I go to forexfactory.com/calendar. I drop the link in the room for you guys. And I'm looking to see if there's anything going on that could make the market a little crazy. Good morning, Bob. And what happens is high impact news has the ability to make the market untradeable. That's the easiest way to say it. The emotional response by the people in charge could be so severe that it could run you right over, that it could change direction, that the market could go so fast you couldn't even begin to recognize whether or not your rules are met. And guys, today is such a day. Today is FOMC meeting minutes day. If you've never watched the market during FOMC day, it's a lot of fun. If you've ever traded the market during FOMC day, during that release, you've probably been run over and beaten severely. I know I have. I did it on accident once. Good morning, Cab. Good to see you. Andy, I'm sorry, man. I wish I had answers. Jason will get you. Something's going on. Something's going on. He'll get you. I don't know why it would just be a 14-2. Not worried. I like that about you. Doesn't do any good, right? So guys, this is just a part of my morning routine, and what you'll find is that trading is very much routines. It's doing the same thing over and over. Successful traders do the same thing over and over. Successful traders have a limited number of trades. More trade, more action doesn't necessarily equate to more money. So we're going to take today and we're going to take the path of least resistance to get you where you want to be. And everything that I talk about does come from the Nexgen page, specifically the trading guide. I'm going to click on that. These are your rules. These are the rules that I cover every day. These are the rules that I'm going to teach you to recognize. I'm going to show you how to study. And I'm going to give you feedback on everything that you show me as you learn to follow these rules. And the rules are for what we call a high probability trend trade. Every morning for the first hour, I know I've got some newer folks in here. Every morning for the first hour, I'm going to talk about a high probability trend trade. This is a trade that typically wins 70 to 80% of the time if you patiently wait for the rules to be met and follow them. This is a trade that, because of that win percentage, that potential win percentage, creates an awful lot of confidence, because they say that confidence comes from the memory of success. So the more successes you can generate as a brand new user, the more likely you are to stick it out, to stick with it, to study harder, to practice more, and to request more feedback. But the most important thing that the high probability trend trade does is it teaches you to read your indicators. And that's my job. My job is to teach you to read your indicators. Some people think Nexgen is going to tell you when to buy, and Nexgen is going to tell you when to sell, and we're not. We're going to give you all the tools so that you can make great decisions. The high probability trend trade is going to teach you to read your indicators, to recognize advantages so that you can make those decisions. And you're going to realize that about 90% of your day, each and every day, sorry, I have to close my office door. I talk loud. About 90% of your day, probably 95 to be honest, is just chart reading. It's waiting for advantages. It's reading those indicators and waiting for the market to show you, hey, here's your pattern. Here's the pattern that you can prove wins more than it loses. Here's the pattern that is testable, that is repeatable. Here are the advantages you need to take your trade. 10% of your day will be actively trading because those advantages are in place. And once you learn how to read your charts, once you get through the very basic concepts that we're going to discuss this morning, you're going to understand some very key factors. You're going to understand where the market is likely to continue. This is going to be your entry for the highest probability trend trade that we teach. You're going to understand where the market is likely to go. This is going to help you with profit targets. And you're going to understand where the market is likely to stop. And honestly, this is going to be a giant red flag waving in your face, saying, don't take that next trade. This is an area that could stop the market. This is an area that could create an untradeable bounce. And you're better off embracing your 90% when you arrive at these areas. So the high probability trend trade. Each indicator on every chart agrees with the rules for the trade. That's your high probability scenario, guys. The best of the best. Only takes 3 rules to achieve it. Each rule, when true, provides an advantage. And I want you to start talking to yourself in terms of advantages. Because when you say to yourself, I have momentum, a clear path, and an entry area, you shouldn't hesitate. You have a pattern that's been proven to win more than it loses. And then the same kind of, it carries over. If you say to yourself, I'm missing this advantage, or I don't have these 2 advantages, well, then you get to put yourself in a position where you can choose to simply not trade. My rules aren't met. I choose to not take a chance on a pattern outside of my pattern. And that's what we're going to work towards, guys. So 3 rules, 3 advantages, and the first 2 advantages, momentum and clear path. These are your core. These are the 2 that are going to carry into everything that you do. Once you understand momentum and path, you truly have everything you need to be successful with the software. You have everything you need to be consistent and build your own trading plan that revolves around that. For all my new users, we're adding in that 3rd rule, that entry area, and this one is specific to the high probability trend trade. This is just designed to show you where an existing trend is more likely to bounce and continue with that trend, guys. And we can do this on only 2 charts. Again, I'm a big fan of simplicity. I try to come off as a smart guy in here. Guys, I'm a daydreamer. I got excited about Unicorn Day today. But I'm good at patterns, and patterns are what yield the results, guys. So we're going to keep it super simple. We're going to take a large chart and a small chart. Your large chart is a slow chart. It's a broad stroke of a brush, if you will. And it shows the overall opinion of the market, the people that control the market. And your large chart, through the most current bar, the first bar printing on that chart, will define the direction, it will define the momentum through rule number 1, and it will define the areas. And it'll let you know whether or not rule number 2 is met. So 66% of your advantages come from the large chart. When they're true, when you have momentum, when your path is clear, meaning that there's no areas that could stop the market in front of you, you're going to turn your attention to a smaller, faster chart. And this is a refinement chart. Inside of that 1 bar on the 13.2, your large chart, you'll see approximately 15 to 30 bars on the smaller chart. You'll see a retracement typically. You'll see a bounce. And you'll see continuation in the direction of the trend, all inside of this 1 bar. And it's this refinement chart where you will pinpoint your best of the best entry, where that trend is most likely to continue. It will allow you to reduce your risk, which makes everybody feel better. And it'll allow you to increase your profit potential, which definitely makes everybody feel better. And rule number 3 is initially specific to the high probability trend trade. When the rules are met, I'll take the trade. The trend trade entry will also work on medium probability trades. And then your entry rules on a smaller, faster chart may change as you grow with the software. You may find more ways to use the software and the charts, but by taking entries on a smaller, faster chart, guys, it reduces risk dramatically. And we use these 2 charts because they're a reflection of who you're trading with or who you're trading against. So the large chart is the big crowd. It's the large crowd. It's the men and women with the money and the influence to create a trend, to build up the momentum that we're looking for in rule number 1. And this is the same group of people that are reacting at those key areas. They're making decisions at Fibonacci support and Fibonacci resistance. And going with the large crowd tends to be the path of least resistance for everybody, because the large crowd almost always wins. Almost, right? Not always. Try to avoid blanket statements. Your small chart is your small crowd. And the small chart, the small crowd still has a lot of influence. They still have a lot of money. And they push. They push against the large crowd. If the large crowd says we're going up, there's a group of yahoos that want it to go down. And the small crowd creates what we call a retracement or a pullback. And it's just a tiny little fight that isn't even visible on that great big chart. But on your small chart, you can see it, and you can anticipate through rule number 3 where their fight is most likely to fail, where they're most likely to lose, where the market is most likely to bounce and continue with the large crowd. Rule number 3 embraces the small crowd's fight, and it finds a way for you to capitalize on it. They typically lose 70 to 80% of the time. Whether it's intentionally or not, that's irrelevant. But you're pinpointing where their failure is most imminent, guys, and that's going to get you in to your highest probability trend trade. This is how our morning goes, and it goes the same every morning, and I think that's a wonderful thing. Repetition, guys. Repetition creates recognition. Hearing the same thing each and every day creates a neural connection. And it's one of the proven best ways to focus and learn something is that repetition. So we're going to take the morning and we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. And I got to tell you, the Sunday school answer is it's okay to trade when my rules are met. It's okay to trade when I have these 3 advantages. It's okay to trade when I have described and I see the pattern that has been proven to win more than it loses. Maybe it's not okay to trade if I don't have those advantages. Maybe for most of you, for a lot of you, you'd rather do nothing than hope. You'd rather do nothing than wish the market would do what the indicators are telling you it's not likely to do. So focus on having the rules met. You can simulate, and this is one of the great things about whether you're on demo, whether you are someone who leases the software, whether you're someone who committed and made that purchase. You don't have to trade live money. You can be on simulator. Hey, what's up, chef? Good to see you, man. And you can practice. You can get that repetition. You can get those reps in. And the great thing is on simulator, you have a safety net. It's like the batting cages or the driving range. You can't do any harm to your account. All you can do is become smarter. So simulate, guys. Practice. Get in there. Get in and out. Work on entries. Work on exits. But post your trades in the room. Every time you post in the room, I'm live 15 hours every week. And the second half of class is feedback. It's feedback on everything you show me, everything you do, every chart read you had, every management strategy you implemented. I'm going to look at it and we're going to talk about it. And I'm going to say, hey, your chart read was great. Or maybe your chart read had a little struggle to it. Maybe you misidentified the momentum or the path. Or maybe you got in too low or too high. Or maybe you held longer than you should have. And you really could have made more money. I'm going to give you everything that I have in my arsenal. So what I need you to do when you post in the room is simply tell me why. Why did you do what you did? And if you don't know why, that's okay. You're brand new. It was green and I bought the market and I just jumped in and this is how it worked out. I'll say, cool, I'm glad that you won, but let's talk about these things. And that's really the first step in getting to where you want to be. The people who post the most in my room typically get to where they want to be the fastest. And the goal is that you're always taking the correct rules, always trading the correct rules, because your rules will have been proven by you to win more than they lose. So you know you have an edge every time you enter. We're going to simplify. This is the third box here. And I'm going to hand you a plan. And inside of that plan will be 2 trades. The first one is your core trade, your foundation trade, that high probability trade. And that means each indicator on every chart agrees with the rules for the trade. Your second trade on that plan will be what we call a medium probability trade. And a medium probability trade means that most of your indicators line up for the trade. However, a small issue exists. And you're going to rely on your chart reading to identify that issue. And you're going to be able to manage a little more assertively because of your ability to read charts. So that's where the second half comes in. You're going to learn these looks. What's it going to look like to get you to pull the trigger? What's it going to look like to get you to be excited about being in the market, guys? And it really is. It's repetition that creates recognition. The more times you see something, the quicker you're going to get to where you want to be. And that's where the second step, on the path to becoming a confident trader ASAP kicks in. Use the spreadsheet. I'm going to give it to you right now. I'm going to pull it up. I give this away every day because a lot of days I update it. And I put more and more and more on there. But the first tab, repetition. This is your basic rules. This is strong triggers. Rule number 1, all the way down, over 50 pictures of it. And each of these pictures has been annotated. This is a strong trigger. This is why it's a strong trigger, and here's what it means to you. And then if you're going to learn to pump the brakes when the rules aren't met, it's important that you understand weak triggers as well. So you've got this juxtaposition. There's today's big word. Strong, right next to weak. Learn the two and know the difference and commit to one. Clear path or a termination condition, an area that could stop the market, guys. Know the difference. And then a little bit on entries there. So I'm going to give you something so that you can use this and really study it and fill it out on your own to create that recognition. There's the client trade section. This is where I pilfer from you guys. You guys say, hey, Mark, check out my high probability trend trade. And I say, my goodness, that's amazing. Let me steal it. Let me put it into the spreadsheet and let my new users use it as a study tool. So there's almost 400 pictures, if not more, of Nexgen users taking advantage of the advantages. There's the entry sequence for long and short. There is ideas on management, and up here is the same management plan that's going to be in the plan that I give you, and it's the most mechanical, basic, emotionless approach to managing a trade that I could ever write. But you're going to grow outside of this foundation, guys, and there's more reasons and looks that you'll see on the chart. And my hope is that you'll start snapping pictures and annotating charts. And you'll say, oh my gosh, this is my perfect look. Let me put 100 pictures in here so that I commit it to memory. And this is how I'm going to manage that perfect look. And let me put 100 pictures in here so I can commit it to memory. And these are the things that I'm starting to see outside of the best of the best. And maybe my plan grows a little bit because I start to recognize patterns in the market. And guys, the market has a memory over and over. And the easiest way to tap into it, let me pull up my Snagit, is to take pictures and to annotate pictures. And guys, this is my 2025 picture count. I'm at 2,160 pictures right now. Every time I study a pattern, every time I work on management, every time I'm putting something together with John Novak that we're creating for you guys, I take about 200 pictures of it and I annotate all of them. And we save them to files so that we can come back and make sure and prove that they do work before we ever try to introduce them to you. So get in the habit of taking a lot of pictures. And then finally, this is your trade tracking sheet. This is the last page. Should probably be the first page because this is the one that when you start to move and shake is the one that you're probably going to use the most. Every day, every trade, you're going to take a picture. You're going to annotate the whys. I had strong triggers. My path was clear. This was my entry. And you're going to drop it into the spreadsheet. So there is a place for pictures. And guys, there's how to annotate for the best feedback, how to paste into the spreadsheet, everything you need. And then for you newer folks, I want to make sure that you do have a way to take pictures and get them in the room. There's a link to the capture software. It's absolutely free. And then what you're going to do is you're going to drop your picture in. You can talk about the advantages that you had. But I think most importantly, don't negate putting the feedback that you received in class into this section. Because what you're going to do is you're going to start to see things repeat themselves in the feedback. Some of them will be positive, some of them will be negative. Or not negative, but opportunities. You may see that you continually trade in determination conditions, but you didn't realize it. And then once we get 4 or 5 pictures out of you, me and the mouse in my pocket, once I see 4 or 5 pictures from you, I start to get what your thing is. What are they focused on? What are they doing great? What do they need help with? And guys, we'll work together to get you away from the things that are causing struggles. And the easiest way to use the spreadsheet or the trade tracking is just wake up the next morning and say to yourself, what worked? You can see the pictures, you can read the feedback, and following rules typically works. And you're going to start to see those patterns that are bringing you success. And if you ask yourself what didn't work, instead of turning your eye away from it and saying, oh, that was a loser, I don't want to take that picture. That was a loser, I don't want to put it in the room. Guys, the trades that you lose, especially as a new user, are the most beneficial trades that you could ever take. That's what simulator's for, to be able to identify the mistakes, to be able to work around the mistakes. And if you do this every morning, it keeps you focused on the good stuff. And it really, it kind of keeps you focused on avoiding the bad stuff. And it will accelerate the learning. It's been proven, guys, for decades. Even the CME, for as long as day trading has been a thing, has told new traders, track your progress, know where you're at, know what you're doing, look for patterns. And that's what we do each and every day. So the first hour here, guys, is very lectury. I know it's very lectury. Feel free to interrupt me. Hey, Mark, you're talking about momentum. I need some clarity. Hey, Mark, when we're identifying these termination conditions, what's that recipe? Don't be afraid to post in the room while I'm talking. It doesn't bug me. I actually encourage it. And then the second half of class is dedicated to your pictures, guys, 100%. So we're going to talk about indicators first. What am I looking at? So I open up my workspace, and I have a large chart and a small chart. And both charts will have trigger lines. There are small triggers, which are 2 solid lines working together. It's a fast-moving average. And that is your small trigger, no matter what time frame you're looking at. And then you have a large trigger. Large triggers are dashed, and they're a slow-moving average. When they're going up, they're green. When they're going red, they're down. And here's the great thing, especially for folks like me that aren't super techie. It doesn't matter what the averages are. It doesn't matter how to program them. It doesn't matter what genius created these in his basement a million years ago. As long as you can tell the difference between small and large, you have the skill set you need to use them effectively. We're going to use them to define momentum on both large and small charts. We're going to use them to define termination conditions on the large chart. We're going to use them to define entries on the small chart. So know the difference, small and large, and then you are set, solid. And then both charts will have areas. Areas are essentially horizontal lines that print on the chart, and they have names. There's the divergence highs, which is the magenta line, prints off of a pivot if the momentum is going away. You'll see a cyan line off a low. It's the exact same thing. It means the market went down and up, and your software said, hey, momentum isn't following price. There's a loss of momentum. You'll see the line print. There's Fibonacci resistance, there's Fibonacci support, there's yellow 1-to-1s, and then you have a midband. And on the large chart, these are where the large crowd's making decisions. These are where trend-stopping, cataclysmic events can happen. These are where buyers buy and sellers sell, where fights happen, where bounces occur more often than not. On the small chart, we're going to use areas for entry, because they're just as bouncy as they are on the large chart, but we're going to let them bounce in the direction of the trend. So as long as you know the names, you're going to be great, because we're going to use those triggers, we're going to use those areas, and we're going to describe a pattern that's been proven to win more than it loses. And we're going to break each rule down individually. We're going to talk about what it means to you. You're going to be able to study it. You have a place to study it. And I'm going to hand you a plan. And by the end of this lecture-y little section, you will have everything you need to be successful with the software. You won't have everything you can do with the software, but you will have everything that you need to be successful. You'll have a plan that has been proven to win more than it loses. The only thing I can't give you is the repetition, is the reps, is the seat time for it to become easy. So everything starts on the large chart. Everything starts on the large chart, guys. Large chart leads the way. It's a big, slow chart, and it must have strong trigger lines. And the only way that I can have strong trigger lines on a large chart is if I'm trading with the trend. So we're going to let it define the trend first. And it's really a pretty easy thing. If the background is green, the trend is going up. And if the background is red, it's going down. Lonnie, the market has been crazy all week. It has been amplified 10 times easily because Wall Street is fighting tooth and nail with one another about the tariffs. And you're absolutely right. The market is screaming, and you have to make a decision on whether or not it's tradable. Guys, green is up, red is down. Doesn't mean enter the market. What it means is look for your rules to be met in the direction of the trend. And then once you decide the direction, the only way to have strong triggers in an uptrend is if both your small and large triggers are green, just like the background. And the only way to have strong triggers in a downtrend is if your small and large triggers are red, same as the background. Now here's the description for strong triggers. In an uptrend, small triggers are up and above the large triggers. In a downtrend, small triggers are down and below the large triggers. Large triggers should be widening, angled in the direction of the trend. And here's the cool thing, because it's really just one look, and this is my little picture to help you think about it. Strong triggers look like scissors that have opened. And when the scissors are open, guys, you can cut. When the scissors are open, you can get work done. When the scissors are open, you know that you have strength. And when you have strong triggers, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum. You'll hear that all day long. Odds favorable momentum. You'll see it annotated on charts, OFM. Odds favorable momentum. It moves a market, it pushes a market, it can break areas, it can cover mistakes. It's when we're using that smaller chart to see that internal movement, and we're buying Fibonacci support. It looks like a tail on the large chart, or we're selling Fibonacci resistance. And guys, strong triggers leads the way. Rule number one is rule number one for a reason. But eventually the scissors close. The small triggers work their way inside of the large triggers. And when the small triggers work their way inside of the large triggers, this is what we call weakness. And with weakness, anything can happen up or down. You'll see that annotated on charts ACH. So for you brand new users, I want you to keep it very black and white. Either you have separation and it's time to look for entries, or you don't, and it's okay to sit on your hands and do nothing. And then Marky Mark, with movement is opportunity to buys. I mean, that's it. The more a market moves, who was it? I think Cav posted in the room earlier. The volatility has been outstanding. Or maybe it was Pete. The volatility, the movement in the market is how we're going to capitalize. Now, momentum is only one of the things, but yeah, when a market is moving, guys, that's when great things happen. So this is crude oil, and you're gonna recognize that crude oil is being difficult. But if you back up just a little bit, all of these moves, there's opportunities. There's potential to make money in all of these moves, depending on your rules. And you'll notice that strong triggers push, and strong triggers push, and weak triggers is right where that market reversed, and weakness is right where the fights happen, and weakness is where the market seemed to turn from the middle of nowhere. But when you had strength, Well, it was even enough to break some of those key areas. So can you guys give me a why if you're with me? Separation means strength. Rule number 1 is met. When the smalls are inside, it means weakness. It's okay to do nothing. Wait for the strength to come back. And it does. I've never seen it not come back. And once you have strength, once you have momentum, this is like a flow chart. If I have strong triggers, then I must make sure that termination conditions are false. I have to make sure that I'm not trading into an area that has the potential to stop the market. Because when there are none present, I'll have room to my profit targets. And we're just going to call it a clear path because it's easier and I'm lazy, right? So once I have momentum, I'll make sure I have a clear path. What is a termination condition? Great question. It's a horizontal line on a large chart. That's the easiest way to say it. It's a divergence high or a divergence low. It's a yellow 1-to-1 or support or resistance. And all of these areas have the potential to stop the market, to reverse the market, to create big untradeable bounces. And there's going to be a comparison of the area and the trigger lines. And once again, the trigger lines show up and they're going to give us the information that we need. Horizontal lines on a large chart, support, resistance, 1-to-1s, divergence highs and lows. These are where decisions are most likely to be made by the large crowd. So to define a termination condition, there's 2 parts. The first part, and the most important part, is that price reaches the area. Your dynamic Renko bars work their way up and hit resistance. And then once they hit resistance, I'm done with price. I don't care about price anymore. Once price reaches resistance, I have to ask myself, where are the triggers? I'm doing this comparison. And if my triggers remain below that area of resistance, resistance is a termination condition. And because it's a termination condition, rule number 2 is not met. Absolutely no trades into the area. And if the market comes down and reaches Fibonacci support, all I have to do is ask myself, where are my triggers? And if my triggers remain above Fibonacci support, well, it's a termination condition. Rule number 2 is not met. Absolutely no trades into the area. There are 4 things that may happen when you reach an area. The area could break. Typically it breaks with momentum. That's one of your options. There could be a fight between the buyers and sellers, the large crowd, as they jockey for position, and you don't want to be a part of that fight. It could create a big, ugly, untradeable bounce. So the reaction off of the area could be big enough to pull you out of a position, but maybe not big enough to stop the trend completely. Or it could reverse the market. Those large sugars could go from green till red, or from red to green. And if a termination condition and the triggers don't break, if it reverses the market, we call that a strong top or a strong bottom. And a strong top or a strong bottom is the precursor to the highest probability trend trade you could ever take. A strong top or bottom is rule number 1 for the second trade on the plan that I'm going to give you. A strong top or bottom is rule number 1 for the high volume area trade some of you will work your way into. A strong top or bottom is rule number 1 for the momentum trade that Nexgen teaches. So while it's not mandatory for a high probability trend trade, it really does set you up for the highest level of success if you find a trend trade after a strong top or bottom. And this is what it looks like. Full reversal right off of Fibonacci areas. But they do break. So let's talk about the life cycle of a fib breaking, of 1-to-1s breaking, of a divergence high breaking. It all starts with price reaching the area. And when price reaches your area, that area is automatically going to be a termination condition. It may be for a second, it may be for a minute, it may be for an hour. But if price reaches the area and the triggers are still below, as they are right here, absolutely no trades into the area. Wait for the reaction. Embrace that 90%. If your small triggers absolutely smash through the area, remember the trigger lines tell the story. The trigger lines let you know what you're up against. but the large triggers are still below. 50% of your triggers have gotten above resistance. 50% of your triggers have remained below. This is the look, as long as you have momentum, that tells you, hey, this area has the potential to break. It could break, it might break, the potential's there, but it's not yet broken. So you're going to have to manage any trades you take very assertively. This is going to be your medium probability trade, the first one on the plan. But when the small triggers and the large triggers, both lines of each get above resistance, resistance now behaves as support. You'll see the colors change. This is your clear path. As long as there's nothing in the way, your path remains clear. Once you reach the next area, you go back to number one. And let's pull up crude oil real quick and just take a look at it for grins. It's a pretty good example. Weak triggers, and look at the retracement, and it's directly to yellow 1-to-1s. And if you're using that recipe, price reaches yellow 1-to-1s, my triggers don't break, absolutely no trades into those yellow 1-to-1s, and guys, that was a good thing because off it went. And then it went to Fibonacci resistance and they couldn't break above, and it came right back to Fibonacci support and they couldn't break below, to resistance, to support. This is rule number 2, keeping you out of trouble. This is rule number 2, helping you stay away from avoidable losses. And rule number 2, guys, this is the most broken rule, but I'm going to show you something real quick. When you have momentum and you're above this area and below that area, this is where the easiest money comes from. And we'll come back and look at that and see if it was an entry. But it's trading away from fibs. It's trading to the fibs. Understanding that with momentum and nothing in the way, this is where the highest chance of success comes from. In a downtrend, it looks exactly the same. Price reaches Fibonacci support. Where are my triggers? Learn that recipe. Well, my triggers remain above support. Therefore, I choose to wait to see what the reaction is. I'm not going to try to predict it. I don't know what's going to happen. It's going to bounce. They're going to fight. It's going to break. And if it's going to break, first it's going to show me the potential. When the small triggers get 3 or 4 points below Fibonacci support, but my large triggers are lollygagging, as long as I have momentum, I know that this area has the potential to break. But it's only potential. And that potential goes away typically with losses of momentum. And if it breaks, small and large will get below. And support will behave as resistance. And your path will remain clear until you reach the next area. And that's kind of the kick of the clackers for a lot of you guys. There will be times when your path isn't clear because the areas are stacked. And this is 90% of your day. This is 90% of your day. Mighty Max, if you can post a picture in there, it doesn't matter to me what kind you use. If it's snipping, if it's Snagit, if it's capture, as long as you can drop me an annotated picture in the room, I love it. I don't have a preference. Does Snippet allow you to upload your pictures to a cloud the way Screencast gives you that ability? I've never worked with the snipping tool. Because that's one of the things that I think are so important, is not just taking the picture, but being able to get that link, because it's that link, Mighty Max, that is going to go into your spreadsheet. It's that link that you're going to drop into your spreadsheet, that you're going to create that little hyperlink. So you do want to be able to retrieve them like that. And I'm not sure how easy it is to post a JPEG or whatever into the spreadsheet. Guys, there's going to be times where it's fib after fib after fib, or fib, divergence low, or fib 1-to-1 divergence low. This is 90% of your day. And it's okay to do nothing. It's all right to do nothing. The busiest traders are rarely the most successful traders. The futures markets trade billions every day, mostly every hour. Trillions daily is exchanged in the futures markets. I did a little research on crude oil. Crude oil typically trades about $200 billion a day. That's what's exchanged in there. It takes 400 of that 200 billion to put you in a six-figure income. I was playing golf with a guy yesterday, and he was talking about investing, and we were talking about futures, and he wasn't sure about it. And he goes, well, what do you have to make, to be good at it? I'm like, I don't know, $400 a day is a six-figure income, and he couldn't believe that it was that low, and most people can't. So finding your opportunities in between the fibs, finding your opportunities with momentum, guys, that's where the success comes from. Being willing to do nothing when there's absolutely nothing to do. So those are your large chart termination conditions, guys, and we'll pull this up again. And sometimes they break. And sometimes it's just weak triggers. And sometimes there's fights. And look at that. From support and then weakness back to support up to the divergence high. They try to break. The potential was there, but the buyers took over and off they went. These big tails coming right off of fibs, that's the reaction. That's the fight. That's the reaction. That's the fight. You know where these areas are. Look at that. And you know that they can stop the market. And it did. After that giant 55.50 up to 56.84. And look at the shot right off of it. And then the fight kicks in again. Weakness at a fib. Back to the mid-band. Divergence high. Back to support. Divergence high. Back to support. Divergence high. Back to support. And finally, the buyers are able to break out to win their fight. And now they're going up. Resistance is broken and it's turned to support. Can you guys give me a why in the room? I love it. Crude oil is putting on an absolute clinic for termination conditions today. Is everybody good with that? Price reaches the area. Lance, Trina, Bob, Nanda, Cab, everybody's good, right? Not trading into an area typically works out better than trading into an area. One of my favorite pictures, I'm gonna bring this up again because I took this picture. This was the day before Thanksgiving. In an 11-hour span, 36 times, rule number 2 kept you out of a loser if you followed rule number 2. 6 times inside of that same time span was easy money, was odds favorable, momentum, and clear path. So very often, it's what you don't do that's going to create success, not sex. Or if it does, there you go. It's your willingness to do nothing. Sorry, I'm on a little bit of a Benadryl today. My allergies are killing me. And this is what separates the winners from the losers very often, is not having to make up for losses that you shouldn't have taken. Avoidable losses kill accounts, guys. So that's it for the big chart. Trina, thank you for giggling at me. There is one small chart termination condition, only one, and it's 3 divergences in the same price range. Divergence needs to become synonymous with loss of momentum. It doesn't matter why they're losing momentum, just know that anytime you see a cyan line from a low or a magenta line from a high, there was a loss of momentum right at that pivot. And if you see it 3 times in the same time frame, and you'll use the exact same rules. Small and large have to get below this divergence for it to be broken, otherwise it stays in play. 3 in the same area can terminate a trend. You'll see it on the large chart and the small chart, but because the small chart, this yellow box, is showing you all the information just inside of that one big slow moving bar, this is the small chart giving you a heads up that things may be changing. And this is the only time I'll let the small chart talk me out of a high probability trend trade if I have momentum and clear path on the large chart. So once those are in play, and I'm going to look for my entry area, guys, this is where the precision comes in. This is the one that really has to be practiced the most, I think. And learn the language. My entry rules say that I'm going to use a limit order, and I'm going to buy or sell a pullback at an area inside triggers. I'm going to use a limit order, which means I'm going to wait for the market to come to me. I'm going to call my shots on this small chart. And I'm going to use it to buy or sell that pullback, that little fight that the small crowd creates. And I'm going to do it at an area, at a fib, at a mid-band, or a yellow 1-to-1. And that area needs to be inside of these triggers, either the large or the synthetic. Because triggers will define where the retracement is most likely to occur. So on the large chart, you'll see it all day long. Price returns to the large triggers. It pulls away and snaps back, and it pulls away and snaps back, and it pulls away and snaps back. So that's one of your gospel truths. Price pulls back to large triggers, whether it's a large chart or whether it's a small chart. So we're going to use those large triggers. We're going to put the large chart and the small chart large triggers on the small chart, and they will define your retracement. So it's going to go somewhere from the top of these triggers to the bottom of these triggers, more often than not. There is a look that creates a higher advantage, and we call it favorable large triggers. And favorable large triggers mean that those large triggers from both time frames, on the 5-1 we call them large. The stepped, we call them synthetic because they're from the higher time frame. So you're large and you're synthetic. They're one on top of each other. They're overlapping. The two snakes riding piggyback. And what this does is it gives you the smallest little price range where the retracement is most likely to occur. And this is going to help increase accuracy. And this is going to give you the smallest, what we call window of opportunity, point where the market is most likely to bounce and continue with the trend. So if you buy or sell a pullback at an area inside of favorable large triggers, guys, that's the precision. And we're gonna put one together real quick. Large chart rules are met. Can't stress that enough. Large chart has momentum. Large chart has a clear path. I'm going to turn my attention to the small chart to find my entry. In this case, everything's going up. The large chart says up. The large chart has cleared the previous resistance. It hasn't hit the 1-to-1s. It's time to look for an entry. So on my small chart, everything else will be going up, and that fear of missing out starts kicking in. Oh no, they're going without me. And then the pattern starts, guys, and that's the reversal bar. So on your small chart, your entry chart, your refinement chart, you're going to let it start going down when the large chart's screaming up, and that's the reversal bar. It signals the beginning of the fight. It signals the beginning of the retracement, the pullback, however you want to think of it to make it easy. And we know that price tends to return to large triggers. So I have large triggers and synthetic triggers on my entry chart. And from the highest line of the triggers to the lowest line of the triggers, guys, this is where the market is most likely to retrace. This is where the small crowd is most likely to be able to push down. The tighter they are one on top of each other, the smaller this area becomes. That will help with accuracy. But does everybody see? Give me a Y. The reversal bar prints, that's not my entry. I define where those down bars are most likely to go. And this is a pretty big box, right? We're going to refine even more. Here comes precision. Once I identify my trigger lines, I know where the market may return. I need an area inside of triggers, guys. Areas can be fibs, Fibonacci support or resistance. They can be mid bands. They'll be green for long trades. They'll typically be magenta for short trades, and yellow 1-to-1s. And guys, they have to be inside of triggers. One of the things that you'll notice in every piece of educational material that I share with you, whenever I write inside of triggers, I put inside all caps. I can't stress how important it is to have your areas inside of triggers. Guys, that giant box turned into a box that is 2 ticks wide here. This is where the small crowd is most likely to fail. This is the point where the market is most likely to bounce in the direction of the trend from the large chart. This is the precision. You're going to activate a limit order, ticker 2 above, the highest support inside of triggers. And now you've done all you can do. That's it. The only thing left for you to do is wish, hope, want, and pray, because you'll never be in control of whether you get an entry. The only thing you'll ever be in control of is whether or not you followed your rules. But here's the great news. If the market comes down to your limit order, if they push down, if the small crowd pushes to that entry point, you're now in a long position. But you're not just in a position hoping that it goes up. You're in a position because you have identified, described, and followed a pattern that has been proven to win more than it loses. You have the advantage of a market where the odds are favorable for it to go up because of strong triggers. You have the advantage of a clear path because there's no key Fibonacci areas in the way that could create an untradeable bounce. And you have the advantage of having entered precisely where the market is most likely to bounce and continue with that trend from the large chart, guys. And this is your high probability trend trade entry. Mighty Mac says, Mark, today the market is moving so fast. What is the rule for when the market is in such a condition because it's really hard to pinpoint entries and exits? So, Mighty Max, there is no rule. I don't have a rule that tells you when to trade, but I think Trina just answered it. If it's too fast, it's okay to not trade today. If I can't make good decisions, if I can't get my entry in the right spot, if I can't get my stops where they belong, if I can't adjust to get my targets where they need to be, the reality is I'm okay not trading. I'm okay not trading. This is 9:49 to 52. This is 3 minutes worth of movement. And I'm not going to lie, this was probably a perfect trade. But if it's too fast, I can't catch it. Right? If it's moving too fast, I got to sit it out. And I know that's a bummer, right? Because every trader in the world believes that if they don't make all their money right now, they're never going to make any. And that's just not the truth, guys. There's 252 trading days in a year. That's it. You don't have to be in every one of them. People take vacations all the time. This may be a mandatory one. No. Mighty Max, I think most of the people in this room will tell you that they're not trading actively during this indecision. Wayne's on sim, right? Because he can't manage his real money. Trina's on playback. So it's okay. Yeah. It's okay to say, holy shit, it's too fast. Pardon my French. It's rare. Guys, this isn't normal. This is an outlier. This is the exception, not the rule. But if you're not a news watcher, there has been some monumental decisions made regarding global trade, and the market is reacting a little bit. High impact news. So let's go through it again and kind of show the whole process. We broke it down individually. When the large chart rules are met, when I have momentum, when the path is clear, everything's going up, I'm going to wait for the reversal bar on the small chart. The reversal bar is not my entry. When I was teaching my wife the high probability trend trade, as soon as the reversal bar printed, she would hit buy. And she couldn't figure out why she kept getting run over. Reversal bar is not your entry. But once the reversal bar prints, you're going to find those trigger lines, large and synthetic, and you're going to say to yourself, this is where the retracement's most likely to go. And then once you do that, you're going to say, but I need something bouncy. I need a fib, a midband, a yellow 1-to-1. I need something solid for that market to ricochet off of. And guys, from the highest point of support to the lowest point of support, inside of triggers, all caps, this is your window of opportunity. This is where the market's most likely to continue. This is where the small crowd is most likely to fail. Guys, your entry goes 2 ticks above it. And here's the cool thing. You have defined where the retracement was most likely to occur. You have defined where the bounce is most likely to happen and continue with the trend. And you can use that knowledge and say, okay, anything beyond the retracement zone, anything below the area is most likely to create a bounce. We're going to call this the wrong side of the triggers. And anything on the wrong side of the triggers is not a part of your entry. Your advantage, rule number 3, is no longer in play. If price gets beyond those triggers, beyond those areas, guys, you don't know if, you don't know when, you don't know where the market may continue up. Your advantage is gone. Reversal bar begins the pullback. God bless futures. We'll make it both ways, right? Define where that pullback is most likely to go. Define where it's most likely to bounce. Get your limit order below the lowest point of resistance. Guys, don't trip over a couple pennies trying to save a few dollars. Anything on the wrong side of the triggers, anything beyond the retracement zone, anything on the other side of the areas inside the triggers, guys, this is where the market shouldn't go. This is where your advantage is gone. We're ignoring all of these lines. And because you can define where the market is most likely to continue, you can use that phrase, this is where the market should not go. Initial stops are placed where the market should not go, guys. 4 to 5 ticks above all the trigger lines in a short trade. 4 to 5 ticks below the trigger lines in a long trade. And if the small crowd has it in them to push 4 or 5 ticks beyond those triggers, guess what? That's part of your 20 to 30%. That's a cost of doing business. Small losses are a very normal part of a positive equity curve. Very often, I'll see new users put their stops down here. Well, I'll just give it $500 worth of risk because who knows, maybe it'll go up. And then that 500 gets hit and they get dejected and put out. Guys, we can minimize our losses by understanding the concepts of where the market is most likely to continue. But you've got to go through and learn the pattern. And this is it, all of it put together. So the large chart has strong trigger lines. Smalls are above the large, the space is there, the scissors are open, and life is good. Small triggers have absolutely smashed through resistance. Large triggers are breaking above it. And the market is trading right about here. And guys, this is everybody familiar with FOMO? Have you heard that one? The fear of missing out. Oh no, the market is going to go without me. Remember, guys, these are patterns. And we're learning to study this pattern right now so that we can trust this pattern, so that we can kind of squash that fear of missing out. Right at this top bar, I'm like, give me a reversal bar. Give me a reversal bar. That's what I need. And then sure enough, the market says, Mark, I applaud your patience. Great job. Here's a reversal bar. And then Lance, you're going to get this one. From the top of that bar, I've got $80 worth of profit potential. That sucks, guys. That's not enough, right? I'm not going to risk all this money for $80. But remember that your entries don't come from the top of the bar. Your entries don't come from the reversal bar. We're actually letting the market push all the way down to support inside of favorable large triggers. You don't see it in this bar. It looks like it's growing a tail. Your entry is down here at this Fibonacci support, which means that if the market continues up with all that momentum, if the market continues up with that clear path, it's actually about $300 worth of profit potential, because great entries reduce risk and great entries maximize profit potential. And you've got to learn to trust it. You've got to learn to study it. And that's where those tails come in. And guys, if the market's too fast to trade this morning, no, of course not, Mighty Max. Because how could you have strong triggers if you're going counter trend? You can't. It's impossible. The only way to have strong triggers is with the trend. Let me show you one of my other favorite pictures, Mighty Max. And this is based on 28 years of teaching people to day trade. This is how you commit financial suicide. It's one easy step. Short story by my brother. Chapter 1, warning sign your friends are in trouble. They're trading against strong triggers. They're trading counter trend. Chapter 2, warning signs your friends are not paying attention. They trade into termination conditions. Guys, this is a little tongue-in-cheek, but these are the two biggest problems new users have. One, not having the patience to wait for everything to be in their favor. And then two, not having the patience to let it get to the other side. You feel like you're the inspiration for those chapters. But we all have to go through it, right, Chef? We've all got to say, oh my gosh, there's a red line, let me go short. No, you get run over if the momentum's against you. Let me just jump in arbitrarily. That's when the reversal bar prints. You're the poster child for chapter 2. I was too. So one of the things you can do, guys, and let's do it right now because the market is too fast for a lot of you to trade. This is a great example. Smalls are above the large. There's space between the two. The large and small triggers are above resistance. And the price bar hasn't reached Fibonacci resistance. Do you guys see it? Let's go back and see what that circle looks like on a smaller, faster chart. There's your bounce. It was a little bit below the triggers. But that's kind of the pattern right there, guys. Momentum and path, find a way. Most of my experienced users will say those areas are on the wrong side of the triggers. That's not rule number 3. That's where the market shouldn't go. And they'll just wait for an up bar. And they'll enter with that up bar because they still have room to make money. That's a progression. Let's go see if we can find another one. This market is just absolutely screaming. There's another one. So there's a circle on a tail. I don't know if that one was going to be deep enough to give me an entry. But I know that my rules are met. And that's what we're looking at. Oh my gosh, look. Pulled right back to the mid-band right at the triggers. There's your pattern again. That was at 48. It didn't blink until 58. That's a 10-point run before the market ever even hinted that something was going wrong. Let's do it again, guys. Odds favorable and clear path. Cleared one area, haven't hit the next area. What's it look like? Oh my gosh, pulled right back to resistance inside of triggers. And guess what? If you missed it, they came back for you right to the mid-band and the retracement zone. They never went where the market shouldn't go. And sure enough, down it goes. So, Mighty Max, if it's too fast to trade, why not go make yourself brilliant? Odds favorable, potential to break. Right back to the support inside of triggers. Again and again. And that's what people don't realize, is that trading is awesome. Trading is fun. Trading is adrenaline fueled. But what am I doing right now? I'm proving to myself that this pattern works. I'm proving to myself that this pattern repeats itself. I'm proving to myself that if I'm patient when the rules aren't met, the next trade is coming. And guys, pictures will pay dividends. And that's why when I promised you everything you need to be successful, guys, I start by giving you Chart Reading 101. So if the market is too fast for you to trade right now, go snap pictures. You don't have to sit there pining over the fact that you can't trade actively. Guys, go back and take pictures of strong triggers. Annotate them. Talk about why they're strong. Create a connection between your brain and your eyes. Do it with weak. Do it with a clear path. Do it with terminations. And I promise you guys, if you take the time to go through this drill, to take 25 pictures each of strong and weak, to take 25 pictures each of a clear path and a termination, you're not going to mess this up. So, Lance, you have the benefit of being brand new. If you went back this afternoon and did this drill, it'll take you an hour or two. You are going to be all sorts of smart coming in tomorrow. You're always going to be able to recognize these, and you're going to eventually piece them together. So take the pictures, post them in your spreadsheet, study them each morning. Make sure you know what you're getting into each and every day. But I'm not just going to say, hey, guess what? You listened to my class once, go do it. I'm going to give you the high probability trend trade checklist. This is the best of 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 the best way to take a high probability trend trade. And it starts from a strong top or bottom. And the recipe for a strong top or bottom doesn't falter. First, it's a termination condition that no triggers get through. And then it reverses the market. And now it's a strong top. And this termination didn't become a strong top until like 8 or 9 bars later. And first it's a termination and then it's a strong bottom. And guys, it's not mandatory. But it adds warm fuzzies on any version that you catch after. And the checklist asks you, do you have odds favorable momentum on both charts? Have a great day. And it's either strong or it's weak. And there is no in-between for brand new users. And it's going to ask you about your path. Is it a termination? Is it only the potential, meaning that you have to manage? Or is it the clear path? And define your entry. And that's exactly how to do it. And when you print this out on the second page, you've got a checklist to keep in front of you to make sure that you're following the rules, to police yourself. You have rules to write on the chart every trade you take. And nobody in the history of this has ever done worse than 70%. And true story, I've had engineers run it through because engineers are thorough. Over 400 days following the plan that I'm about to give you. And the results were like 83%. So adherence to something that presents itself as simple in the beginning will open the doors for more. And then I'm also going to give you the KISS plan, guys. The Keep It Simple Sunshine Plan. Hey, easy killer. Guys, this is a stepping stone in your learning journey. And I put that on there because so many people get upset that they can't be active for 90% of the day. I firmly believe, and I'll say it from the highest mountain, you don't need more than this to be a successful day trader. I don't believe that you do, but a lot of you are going to look for things outside of it because you want to be busy. Guys, this is designed to optimize your chances of success with a high probability trend trade as you learn to read your indicators. And then through simulation study, class feedback, notice that it's underlined, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. When you can read your charts, when you can identify advantages, when they become easy, you will see more opportunities. You don't have to add them into your plan, but you certainly can. But there's 2 things you have to know before you sit down to trade and you're not on simulator. Why will I enter? The easy answer is because my rules are met. Because my rules are simply a description of a pattern that's been proven to win more than it loses. Guys, we just did that. We just scrolled back on the S&P and we saw the same pattern present itself 5, 6, 7 times. And that's just today. So if you take that time to study, if you go circle those tails, if you look at where the bounces are coming from, you're going to learn to trust it. And when you trust it, you don't have any qualms about activating a limit order. When you trust it, you don't have any reluctance to putting your stop where the market shouldn't go. You'll demand that they come get you. And it'll help remove a lot of the emotions because you know you have an edge. And then you have to know why you'll exit your trade. This is the hard part because when you enter a trade, it's easy. Your brain doesn't care. Hey, all I have to do is push a button. But the second you see those ticks going up and down and you're in a position, your brain's going to tell you that you have something to lose. Your brain's going to say, what if? Mighty Max, what if this is one of that 20 to 30%? Maybe you should just get out just in case. And your brain's going to say, hey, Bob, be the man. What if this is the one time that area won't reverse the market? What if the odds changed somewhere in the middle of the trade? Don't you just want to hold it? What if? What if? Because you can make more money. Guys, the what if demon will get you. So once you define your entry, and you get into the trade, your management, especially new users, should be as black and white, as if then, as pragmatic, as emotionless as you can possibly make it. And that's what I've done for you guys in the KISS plan. It's based on 2 contracts. Your first contract is the one that's going to teach you that it's okay to get paid. Your second contract is going to teach you to trust the advantages from the large chart. So 2 contracts, and this plan is designed to help you understand and trust stop placement, and it is focused on getting you paid, guys. Traders hate small profits. I have no idea why that's the case. Traders hate $100 trades. I love $100 trades because they're fast, they're over quick, the adrenaline goes away, and it only takes 5 $100 trades to make $500. My P&L doesn't know how it got there, it just knows that it's there. So your very simple if-then plan is dependent, first and foremost, on your ability to understand entry. So I encourage you guys, take 20 days, study, post 1 million pictures in the room, make sure that you have this. And if your entry is 2 ticks below resistance inside of triggers, then your initial stop is 4 to 5 ticks beyond the triggers, guys. This is where the market should not go. If this is going to be part of that 70 to 80%, this is where the market should not go. And you will know your risk before you ever enter, which means that when I entered this trade at 71.34, I knew without a shadow of a doubt that my stop had to go at 71.49 to be where the market should not go. You'll get to where you can calculate risk quickly. That's $150 per contract. And you have to be okay with $150 per contract. If you're not, your best course of action is to not take the trade. Because if you try to circumvent the process and put your stop below an area inside of triggers, it could go up and hit that and then drop and leave you behind. And if you put it in the retracement zone, you're still likely to get hit. So guys, be willing to accept the risk. Targets are predefined 100, 200. Did I mention that if you're on simulator, it could hit your stop 1,000 times in a row and your quality of life doesn't change? But if they don't hit your stop, if it's one of that 70 to 80%, you're going to get that reversal bar in the direction of your trade. And when this happens, you're going to redefine where the market should not go. You're going to say, man, now the market's going down. It's confirmed it. I'm going down with momentum. I'm going down with a clear path. I'm bouncing off the areas most likely to create a bounce. And your new stop goes 2 ticks above that reversal bar. And now instead of $150 per contract, you're sitting on about $30 per contract. And this feels good. And you're only a couple ticks away from your first target. That first target's $100. And if they don't stop you out, it means that they hit it. This is the victory, guys. If price reaches your first target, 1 contract is automatically removed. Those funds go into your account. With 1 contract remaining, you're going to move your stop to break even. So you're successful. You just had a victory. The money went in the account. They can't take that from you. Your palms start to dry up a little bit. Your pulse gets a little slower. Children sing songs about you in the streets. And guys, this second contract, holding for the second target, this is trusting the large chart. This is the one that makes you begin to believe that the only reason you ever took that trade was because the large chart had odds favorable momentum and absolutely nothing in the way to stop it. And you're learning to trust that it's more likely to hit 200 than it is to hit you at stop even. And if it hits that $200 mark, that means that you're no longer in the trade. The emotion is over. You can finally breathe again. The butterflies in your stomach have flown south, guys. And you're removed from the position with $300 in your account. And this is one of my favorite objections, and I've had it. Mark, $300 is kind of a BS number. I can't make a living off $300. Guys, that $300 was 4 minutes of your life, not the whole day. But if that's the best you do every day, That's a $75,000 year based on your trading, 252 trading days in a year. Maybe you take another trade and you only get break even, $400. That's a six-figure income. And you're going to see today how people can use copiers. And if you took $100 a day, you could spread it out over 10 accounts, and suddenly it's $1,000 a day from that one trade, grabbing $100. And guys, it's a pretty cool thing that you can do that, but you've got to learn how to get paid consistently. You've got to learn how to not give it back when you shouldn't be giving it back. You've got to learn how to insist on an edge. And that's kind of what we've done this morning. Where's all my pictures? We've learned the rules. You've learned the rules. You've at least heard them for the first time. I'm going to drop this in again. Everything you need, guys. I promised you that. We've taken the rules. We've broken them down individually. I've given you a spreadsheet. It shows you exactly what it looks like to have them met. You know where to find them. You know the names of the indicators. You know how to circle tails to go find your pattern. You have the ability to simulate. And I say this as we get into the second hour, guys. Practice everything. As a new user, take all the trades that you think you see. You might come up with something brilliant that I'll steal from you. It's happened before. Practice. But when you practice, focus on having these advantages and take the time to write out whether or not you had the advantages. And post it in the room. And when you take the time to write the whys, what you're doing is you're creating a recipe for repeating the good stuff. One of the things, I won't say aggravates me, but one of the things that gets me is I always ask, guys, it's an educational room, do me a favor, tell me what you see. And people just jump in and jump out, throw it in the room, but because they made money, they want a gold star and a scratch and sniff sticker and maybe a virtual high five, but they don't know what they did. And trading is about repeatability. Trading is about validation, making sure that what you're doing can be repeated day in and day out for long-term success. And getting lucky is short-term success, and it typically leads to long-term failure. So post in the room, but tell me why. Fill out your spreadsheet. Go back to it every day. The more pictures you take, the quicker you're going to get to where you want to be. You can't take a trade right now because the market's moving too fast. Take pictures today. You'll still be a better trader tomorrow. So you have everything that you need. And then we're going to go into the second hour here. In the second hour, let me go to one more little thing. I do a lot of writing, guys. Do a lot of writing. The key to everything, and I'm saying this to all you folks that are just trying to learn and you want to get to the money before you get to the process. The key to everything is having a foundation. Understanding the basics, the easy trade, the easy to identify, the highest probability winning trade. And then compounding a little bit, getting a little bit better every day. There's the Japanese philosophy, Kaizen, and it means 1% better every day. So for you brand new users, you know who you are. I'm going to blanket you with very conservative rules. I'm going to blanket you with just focusing on recognition of advantages. I'm going to hand you a solid plan that optimizes your chances of success as you learn to read your indicators. So for you brand new users, all termination conditions are bad. No momentum is horrible. Trading from the wrong side of the triggers, might as well nail your foot to a 2x4 with a nailing gun. You're doing it wrong. But the reality is these blanket rules increase the likelihood of success. And success comes from the memory, or confidence comes from the memory of success. These things aren't always bad, and you may find a way to trade around them, to use exceptions. But until you have the reps to do it, this is just safer. Higher chance of success. Andy, the platform's not built yet. It's not done yet. So just like anything, guys, the more times you spend with it, the more you're going to see this opens doors. Learn the process that yields results. If you have never Googled the name Mark Douglas, if you have never Googled the name Mark Douglas, do it this afternoon. Go watch a video. And that's his phrase. The process yields results. When you stop worrying about making money, when you stop worrying about winning trades, you tend to win more trades. That's where the KISS plan comes in, guys. If you keep it that basic, if you follow simple rules, and here's, as we go into the second hour, if you're okay not finding all the trades, but rather the best trades, you can find an extraordinary level of success. And guys, I've been watching it for over 5 years now. The further new users deviate from the simple, the longer they take to learn how to be comfortable with pattern recognition. The more you look for, the less you tend to find as a new user. So question everything. I want you to. I want you to learn. But I also want you to give yourself a little bit of grace, new users. You're brand new. It's okay to be. And that's going to take us into the second hour where we start looking at all the trades. Andy, your Ninja Trader can't keep up? Mine's keeping up just fine. But I could also launch a space shuttle from my computer. Guys, when there's such volatility, I mean, it works, right? But I don't really have enough time to get in. That was momentum and path. That was a pullback to resistance. There was my reversal bar. Oh, look at that. It missed my first target. Guys, I don't know about you. It's difficult to react that quickly, isn't it? It's difficult. There's my first target. Got to be break even. There we go, guys. That was the KISS plan. You just watched it live in a market that nobody in here can keep up with. Why was I able to do that? Why was I able to put my entry in the right spot? How did I know to put my stop in the right spot? Guys, because I've been doing this long enough that the repetition created recognition. Does everybody see it? Guys, that was, hold on. Well, it's not showing it. That was a $300 trade, and it fit the rules 100%. I couldn't have done that as a new user. It's too fast. But that's pretty amazing. I love it. So we're going to go into the second hour, guys, and we're going to talk about it. You guys want to try something crazy just for grins? I'm going to take the S&P. You want to see if we can circumvent a little bit? Let's turn the S&P. Let's go to our data series, and you don't have to. And I'm going to set this up like NASDAQ. And I'm going to turn my 13.2 into a 34.5. But my goodness, that market is screaming. So one of the reasons, and I'm probably, it's going to crash, I can feel it. One of the reasons that the NASDAQ is so difficult to trade is because of the speed. And one of the ways that people circumvent that is creating a 34.5 instead of a 13.2. So this chart, when it comes up, will be 3 times larger than the average large chart. And then what I'm going to do is I'm going to turn my entry chart into a 13.2 chart. And guys, we'll see how the S&P flows like that. The patterns are the same. We're just going to up the time frame a little bit. This could take a second. Are there any questions before I take my first break, before we get into it? Let's do this. Let me see if I can close this without crashing. Maybe. I have my moments. Okay, so here we go. So now I have a 34.5, and then what I'm going to do over here is I'm going to turn this into a 13.2. So I'm going to go to my data series. And I'm going to turn this into a 13.2, and I'm going to apply it. So now instead of 13.2 and 5.1, we're going to have 34.5 and 13.2. We're just going to go up a range. If you do crypto with the software, and you can do crypto with the software, guys, this is like a 3,400 because you have to have that way higher time frame. A lot of fibs on a 34.5 here. I should have done this on crude oil because it loads faster. And then I'm going to have to put in, I'm going to use the NASDAQ 13.2 template because it's going to set me up with my large and synthetics, and the synthetics will be from this chart. And we'll see what it looks like, and we'll go back and circle some tails. So while that loads, guys, I'm going to go refill my water real quick. I'll be back in just a minute. Post them if you got them, and we'll start looking at all the pictures. And if you have questions, post them in the room, please. I'll be back in just a minute. And let's just see, we amped up the size. Termination still work. Lonnie, the answer is no. So Lonnie asks, can you have a strong top or bottom without a termination condition? And the answer is no. And I'm going to show you why right now. So you're asking, Lonnie, can that be a strong top, right? It's a great question. It's a common question. So here's the definition of a strong top. It's a termination condition. Whoa, whoops. Hit some hotkeys there, I think. It's a termination condition that reverses the market. So what happens is price comes up and then price goes down 2.5 bars, Lonnie. And it's not until that 2.5 bars down that the divergence prints. And since the recipe for a termination condition is price reaches an area, triggers remain below here, it never happened. Price created the area. It didn't reach it. And that's pretty common. People are like, oh, it's a strong top. But it's not. So what has to happen is price goes down. Whoops. Price goes down. It goes back up. And then when price retests that line, this is where we can get one of those termination conditions. So down here, price created the divergence low, but they never retested it. It never had a chance to be a termination condition. Does that make sense? When they retested it, we respect it. And what it is it literally becomes this line in the sand. And I like to think of it, and you can see how effective it is right here. Right here, the buyers told the sellers no more. To heck with you guys. Not only are we going to push it up, we're going to steal your momentum, and you're going to know that we did it because you see the cyan line. And the sellers very often say, but buyers, we really wanted to go down. And then Lonnie, do you see this right here? When they reach that divergence low, the buyers tell them, guys, we told you no more. We even stole your momentum. And then sure enough, the market rockets up right off that divergence low. So absolutely, it's when price reaches a divergence low, when price reaches a divergence high. Let's find an example. Whoa, sorry. First, it's just a loss of momentum. And then, Trina, yep, this is what we call a pivot stop out. Let me make this a little bigger. And you actually have a couple in a row. So check it out. First, it's just a loss of momentum. Not a term. And then here, price reaches, triggers above, now it's a term. And then what Trina's talking about, if price goes a few ticks below a divergence, high or low, and trades back above, it's a pivot stop out. And let me show you exactly why. So here's your pivot, down and then up. And then the sellers are like, man, we got them this time. Look at all that momentum. And the buyers let them get a couple ticks below and then stop them out and push them up. And that's where they literally stopped out all the buyers. And then they come back again. or they stop out the sellers, and then they do it again right here. So you see that a lot. So good lesson, great question. And guys, we're running the S&P like the NASDAQ right now. 34 fives. Termination conditions still work. And I'm looking to see $9.38. Let's go see what it looked like. Have to be a little more patient on a big chart, it seems. But there we go. What do you guys think? Momentum, potential to break, pull back to support right inside of triggers. It's still the pattern. Maybe this is a way. So Morgan, when I went up a level, I had to put the NASDAQ template on because the NASDAQ template is designed to pull from the 34.5 triggers. Pretty cool, right? But guys, it's the S&P. It's just at NASDAQ levels because of the speed. The patterns still work. And then I would go ahead and load the NASDAQ 34.5 template on there as well, because you can see that the reversal bar was wrong. All right, guys, we're going to start looking through some pictures. Sorry if you heard a crunch. I had a throat lozenge. Allergies are absolutely decimating. All right, so we're going to start with Pete. It's the Pete show. And I love that he started with this one. You knew it was the Pete show. Pete said, check it out. How I ended yesterday. Had trouble with the copier. That happens. And Pete has a lot of accounts. And he just copies across, but not his best day was still a $3,500 day. I think the day before was 10 grand. I'd take bad days like that all day long. And I like that you share that, because guys, you can do it. You just have to build your plan. And let's see what Pete does to get there. And I like this one. Pete, 3 divergences, strong top, odds favorable, potential to break, right? And they ran you right over. And I even took a picture of this one for you when I saw it this morning. And this is a good lesson for everybody, I think. Come on. So when the market has defined a range, when the market has told you 3 times at a top, 3 times at a low, hey guys, we're stuck. Rule number 2 has 100% identified that we're stuck in a range. You can see it. When they try to break out of that range, sometimes it's what we call the fake out breakout. And I never really understood this when John would talk about it years ago. And what it is the buyers tried and failed, and the sellers tried and failed, and the buyers tried and failed, and the sellers tried and failed, and the buyers tried and failed. And you can literally see their failures in terms of termination conditions. Well, of course, they're both trying to win. And very often you'll get one of those 50-50s outside of the range, one of those potential to break looks. And man, these either die fast because the buyer said, just kidding, we're going to push, or they drop like a ton of bricks. And you never know which one it's going to be. So anytime, Pete, you can define that range where they're stuck, you can say to yourself, I'm gonna manage a little more aggressively on a 50-50. Did that work, Morgan? Cool. As long as you realize it's not trading advice, it's just a way to slow down a market. So when you know that the 50-50 has the potential, maybe you latch onto that reversal bar a little bit harder, Pete. Good lesson there, though. And then when everything is up and there's absolutely nothing in the way, I like it, Morgan. Pete says, with all that momentum and a clear path, you've heard that before, right? I'm just going to jump in and take it to the fib. Absolutely beautiful. Because with momentum and path, it's hard to stop the market. Gap theory pullback trade. What the heck is a gap theory pullback trade? Pete says, this is a pattern. When price reaches the mid-band and the large triggers remain a full bar away, this is what defines the mid-band as a termination condition, because you guys may remember we said price returns to the large triggers. There it is up there as well. Price hits the area, the triggers are a full bar away, price returns to the triggers. Pete says, wait a minute, I've seen this pattern, I know this pattern. Let me see if I can't get to the right side of those small triggers and trade it right back to the large triggers. Pete, this is perfect execution. On a pattern that tells new users don't take the long, you found a way to take the short. I mean, that's solid. Everything says down. The path is clear. Pete jumps in again, but it turns into a trend trade. And Pete, you exited right at the area inside of triggers. They got you. Because it was moving too fast to move your stop. I saw that. Oh, that's nice. And the followers paid you. They didn't keep up. But this is a good one. So for y'all that are learning these entries, if you jump in because of momentum and path, and you get one of these reversal bars, with this look, it's more likely to turn into a trend trade. And that is about the worst spot ever for your stop. You either have to accept the risk or exit the trade. Because that turned into the perfect trend trade. And Pete was able to capitalize. And his follower accounts that got you yesterday, Pete, there's karma, right? They messed with you yesterday. Copiers are what I like to call a bitch goddess. They give with one hand and they take with the other sometimes. All right. Took this one on Sim. Why? Because it's directly into a termination condition from a weak bottom. And guys, I think I'm gonna give an opinion, not trading advice. It is my opinion that if you switch to simulator so that you can break rules, you're more likely to break rules in the real world, especially if you win on simulator from breaking your rules. And I believe the market allows you to win just enough so they can take your money in real life. And I know that you get bored, and I know that you want to be in the market, and I know that you want to be active. And guys, this is such a recipe. This is such recipe for problems for the new user. And that's, Pete knows what I'm going to say. And I love that. You have to have time on the pond. Guys, you've got to be able to switch your brain between real and fake. And your brain has to be so in tune with what's real that it's capable of ignoring what's fake. And Pete's at that point. The average user is not. And then nice run up, but weak triggers and divergence. He says, man, I don't have momentum. Don't have an area inside of triggers. I choose to do nothing. And this is what separates the Petes from the Marks 5 years ago. The ability to do nothing when you don't have the advantages you need to enter the market. Great job, Pete. Oil tanking on a huge sell side volume. 6,000 contracts staying out for a while the craziness is going on. I don't have all of these volume indicators. I don't understand them that well. But what Pete's saying is when they are frantically selling, just let them do their thing. Let the large crowd do their thing. They'll give you your setup eventually. They almost always do. Strong trending market, nothing in the way. Get in before the fib, get out at the fib. Perfect. Great job. And guys, you'll notice, I don't think there was one high probability trend trade in there. Pete learned to read the indicators, found patterns that resonate with him, and created a trading plan based on his ability to read the indicators. That's kind of the hope for all of you guys, is that you're capable of doing that. Then Andy, when everything is screaming up, you find a way to scream up, but you're missing a lot of indicators on there. I hope you were able to get that fixed. And I don't think we're going to have a whole lot of posts in here today, guys. I'm going to click on them, but I'm going to rely on you to ask me some great questions. Odds favorable, everything screaming down. Pete says, I'm just going to jump in with that momentum and get paid. It started with the high probability trend trade. Thank you for that, Pete. And that's one of the things. Once you understand momentum, once you understand path, and he had momentum and clear path, and he said, I have momentum on both charts. I have nothing in the way on both charts. What are the odds? What are the odds that the market's going to stop me out before I hit $100 in profit? Pretty slim. And he goes, if I don't get a close on the other side of the triggers, I'll take it to where the market's likely to go. And guys, this is what's called a chili dog. And this is developed by a Nexgen user. And it relies solely on momentum and path. And that's one of the reasons why I'm so vocal. Learn momentum and path. Be able to identify strong triggers. Be able to identify whether or not you've reached the area and whether your triggers have cleared. And guys, this is what I talk about every morning. You'll find your money trading away from fibs, trading to fibs. And this was 200, 400. This was a $600 trade. And his timestamp is about 2 minutes. $600 in about 2 minutes based on momentum and path. And you guys don't realize how much I appreciate you experienced users that come into the room that show these newer people, yes, the software works. Yes, you can make money with it. You've just got to find your way. So thank you for taking the time. Weakening triggers, not a clear path, 3 divergences in the same price range. And Pete says I'm sitting on my hands. The same lessons you guys got this morning. It's not momentum, it's not a clear path, and even the small chart is showing you change. It's okay to do nothing. I love this. I don't know about you guys. I have a great time looking at your charts. Let's see. Wayne. There's that price reaches the mid-band. Large triggers are a full bar away. And Wayne says, let me get to the other side of those triggers and trade it back. There it is. And divergence helps. Trading the gap. Nice one, Wayne. And chili dog. Momentum on every chart, nothing in the way. And Wayne says, why don't we just make a couple $100? I love it. All right, I show this a lot lately. Has everybody in the room seen Moneyball? Brad Pitt, what's his name? And the whole basis of this movie is they're building a team. And instead of looking for home run hitters, I was looking to see, there it is. But what can he do? He gets on base. That's it, guys. Base hits. Thank you, Wayne. Base hits pay bills, guys. Base hits add up. $100 a pop. Oops, Wayne, I closed your second one out. Let me go back to that. If you can find a way to make $200 5 times a day, just $200 in a market that trades billions, if you can find a way to make $200 5 times a day, you're setting yourself up for $250,000 year. You don't have to make all the money every move. Make the best money. Odds favorable. Get in on the other side of trouble. Trade it with momentum to the next area. So the one thing that you didn't do here, Bob, is you let price clear the fibs here. If you were really looking for that chili dog trade, your entry is about 66 when you get away from the trouble on the big chart. Because where you're in at 80, it's still a termination condition on the large chart. And it's a termination condition from a weak top. Does that make sense? The small chart will talk you into some nonsense. If you're really trying to take that chili dog trade, you let it clear here. But Bob, the one thing that you did have on the small chart, small triggers break the area, snap back to the fib. This is the momentum trade that Nexgen teaches. Right off of that fib to carry it down. Good stuff. Lance, how we doing? I know it's a lot in the first couple days. You folks that are new, how we doing? It's like drinking from a fire hose in the beginning, isn't it? It's like, there's just so much coming at me. Promise, if you keep it a little simple, if you keep it a little focused, take a little time to learn the basics. It's by day 3 things really start to click. By day 5, cool. By day 5, Lance, you're like, oh my gosh, I'm nailing entries. And then by day 10, you're like, watch how I can break my rules. Normal part. Awesome. And don't be afraid to ask questions. I am here for you. All right, Boaz has started incorporating a 21.3, an even higher time frame. Where's your 21.3? Well, I don't see it. And he's got momentum on his large chart. And then Boaz, we talked about this yesterday, right? So your 21.3, your big chart, had odds favorable momentum. And your second chart below it, we could call your 13.2 the small chart, had a pullback to a midband. It's just a trend trade. So Boaz is using an even higher time frame, the way we did with the S&P, to set up for trend trades on his big chart and using the small chart to find his entry. And Boaz, the one thing that's going to help a little bit is let it get to the area and then that confirmation bar, that reversal bar on the small chart, because this is an area and it could do this. So if you wait for that down bar right from the area, I think you're going to find it's going to keep you out of some headaches. Good stuff, man. Good stuff. Morgan. Odds favorable, 50-50, no divergence, perfect entry. Oh, and they gotcha. Those sons of guns. They got you, Morgan. It's the perfect entry. Perfect stop placement. And then those sons of guns. I'll take $45 losses all day long. All day long. Strong top, potential to break. Jump in trade, got clobbered. So one of the things, I want to talk about this 50-50 trade. We're seeing a lot of them. And it really will. It'll probably be the majority of your trades. I want to talk about what the plan says for the 50-50 trade. And again, guys, remember the KISS plan is designed to optimize your chances of success. And there's a couple things that are really important. The first one's that strong top or bottom. This is the one I prefer to not do without. Odds favorable momentum, not only on the 13.2, but also the 5.1. Because remember, what you're doing is you're gauging advantages, and you will have momentum, or it can't be a 50-50, but you don't have a clear path. And this is good for you new users because you're going to begin to think this way. If I have momentum and a clear path in an entry area, well, then I take the high probability trend trade. If I have momentum but not a clear path, then I know exactly which two advantages I need to focus on. I need to not give up any more momentum, and I need to make sure that I've got a relatively low risk entry. And if I'm giving up momentum, I sure as heck better have a clear path in an entry area. And if I have momentum and a clear path, but my entry area isn't clearly defined, I have to be a little more conscious about where and how I get into the market. So when you start talking to yourself in terms of advantages, what happens is you begin to understand what you're not willing to accept and still take a trade. So if I can ever find my internet, so it has the potential to break, but divergence is a loss of momentum. Divergence is a loss of momentum. So now I'm sacrificing from two fields in terms of advantages. And this is where, if I really want to take this trade, because I don't have a clear path and I'm losing momentum, this is where the idea of a confirmation bar pays huge dividends. And you tried to take this as the momentum trade. I totally get that, Pete. Pete said, I'm going to try to jump in. Bob, this is why we let the bar clear. Because decisions are made at key areas. So when you take this one, you can either exit with the close, take a few ticks, or you can hope that it turns into a trend trade. But it's already a 50-50 with divergence. I think this is one of those ones. Yeah, take your little hickey, and then if it sets up, take it. And you did, and you made it back. But a willingness to take a loss is a difficult thing to develop in yourself. A willingness to exit a trade. Remember that little what if monster I talked about? But what if it bounces off of the top of the triggers? But what if it bounces off the mid band? Pete, you're going to hate yourself because it's going to go down without you. And the what if gets you. And then you shoo it away and you say, wait a minute. All I had to do is let it confirm. All I had to do is let it head in the direction of all this goodness, and then it became pretty easy. And it's nice when you don't have big losses. And again, I don't worry about you guys. I know what you're capable of. But we all have moments. Uh-oh. This was a mechanical issue. I right-clicked in the area with the price 10 ticks below in order to put it 2 ticks above the mid-band. But when the market flashed up and it entered before you were ready to place the order in the correct spot, had to put the market order above the divergence and then move it 2 ticks above the mid-band. The market never would have entered me into a trade, saving the loss. Man, it's a good-looking trade, too. It just failed. But yeah, that happens. They just got you. When the market's screaming, look at the timestamps. Look at the timestamps. There's got to be a point where you say, 1 tick net gain. There's got to be a point where you say, when I get 8 or 9 bars in 6 seconds, it's hard to trade, guys. It's hard to trade. But yeah, that happens sometimes. That's, I guess, Wayne, that's the one fallback for your bringing it down and putting it in play. Is I guess that's got to happen every now and then in the markets that are screaming. It's the right idea. Just too much movement. All right, Miss Trina, let's see what you did. I love that you take care of my old tired eyes. Thank you for that. Strong bottom? No. Trig through, close to fib. Odds favor momentum, trigs wide-ish. We're a little indecisive today, Trina. It's 50-50. No divergence. And you still were able to make your first target and get stopped out break even on a trade that failed. That's pretty cool. Nice management. So Trina, the one issue here is not a strong bottom, right? You did have 3 divergences. It was close. When you took this trade, and I just want to do this real quick. When you took this trade, because I understand how moving averages work, your small triggers probably looked about like that. Just prairie dogging above that fib, right? It's an iShoe. Apple came out with it. So one of the things that I talk about every day when we're talking about the potential to break, let me figure out where my pictures are. And I try to be really clear with the language because I think this is so important. Is I use that word smash, Trina. 3 or 4 points through the area, because what you're doing is you're getting that moving average way ahead of the game. And when your triggers smash through an area, it's very likely to break, or more likely to break than it is to fail. And if your triggers could just barely see through, you're not really giving yourself that solid advantage. Does that make sense? So when I'm doing 50-50s, smash. I mean smash. I really, in my personal opinion, I want my large triggers really close to that area as well. Because look at how far below the area you hope breaks. Look how far below it the bottom of your retracement zone is. And if they get all the way down here, what's the likelihood they're going to get through? So embrace that word smash. I like it, and I love that you took the right entry and you got paid and you got out break even on a trade that failed. And that's pretty awesome. That's solid, solid management, Trina. And because you knew what you were up against, you knew you had to manage aggressively. You're so smart. All right, Mr. Lonnie, let's see what we have. Weak top, I agree. Strong triggers, heck yeah. Clear path, looks like you had it. Pull back to the mid band inside of triggers, you better believe it. And out for a tick. Hey, Chef, have a good one. All right. Lonnie, are you with me in here? All right. So, apparently golden geese are shoes. Did anyone know that? Try that one. All right, so what you had, have a great day, Mark. What you had was the golden goose there. I'm just being silly at this point. What you created with it was fried chicken, which is delicious, but it's not the golden goose. And I love so much about this. You wait for the momentum. You get the clear path. You have the perfect entry. And you ditch it for 2 ticks, Lonnie. Can you tell me why your target is $30 away from your entry? It was the perfect trade. And for me, when I did this, it was because I had lost a few in a row. Just practicing, right on. So your entry, you nailed it 100%. So one of the parts of practicing, and guys, I can't tell you what to do. I can't make you do anything. But one of the parts of practicing is this. And Lonnie, this is where money is made. Entries are great. Go back and circle entries, do all that. Practice management too, because management is where money is made. Money isn't made on entries. Guys, all of you will have these entries in a few days. It's what you do with it that's going to decide how much money you're making as a day trader. Exhibit A. Even on failed trades, you have the ability to get paid with a solid management plan. So, Lonnie, it's awesome. Nothing but props for the entry. Let them play out, man. Let management be a part of your practice because that's such an important part of what we do. And I just love that phrase. And Lonnie, if I had a nickel for every time, yeah, get that KISS ATM on. Let it plan out. If I had a nickel for every time my brother said, dude, you're turning the golden goose into fried chicken. And it laughs me up. And that's how I associate anytime I take something great and don't do it well. It's kind of funny. All right, Wayne, the heartburn trade. If you're going to go counter trend, if you're going to fight triggers, let it be from a fib, right? Range, this is a white bar trade, guys. This is a breakout trade from a key Fibonacci area. John Novak used to teach this. Wayne, your execution is perfect on it. Understand where the market may stop. Force it to print a white bar. Find a way to get quick profits. Oh, he's on a phone call? No worries. Tell him I said he is crazy. Batshit crazy for fighting. No. He did this one perfect. Did it perfect. Uh-oh. Andy, different colors. You threw me off. Your triggers are out of bounds. Yeah. Andy, I don't know if it's a computer thing. Mine have stayed intact through all of the volatility. But again, I've got a super fast computer. Have you tried building a new workspace? Great trade, by the way. Well, actually, it's directly into a termination condition, 100%. Weak triggers directly into a termination condition. You get in from the wrong side of triggers. Actually, it's a very risky, aggressive, right into an area more likely to stop the market trade. Weak triggers, wrong side of the triggers, huge loss. Just enjoy the class. No worries. Have you tried the F5 where you rerun the Ninja script instead of just doing the historical data? Yeah, I figured you had. I think you and I have the exact same checklist when things aren't working. Right on. I'm a worrier though. You've been in my classroom long enough. I'm a worrier. That's all the pictures. That's all the pictures, guys. So here's that big ES chart. No, you're good, Wayne. Sometimes the phone rings. We'll go over it again with you in here. Trina started calling you names. I asked her not to. Trina's like, he's crazy, he's aggressive. Do you see what he did, Mark? And I was like, Trina, just relax. He's got a plan. So the first one was a chili dog, and it wasn't. It wasn't even close to a chili dog. Because you had momentum up and you went short. So not a chili dog, not even a little bit. I'm not sure. Whoa, what was that? I'm not sure what got you short here, but counter trend, termination, white bar, I like it. S&P is screaming, isn't it? Was that an opportunity with all that momentum and the potential to break? Is crude oil doing the same thing today, guys? All the divergences probably keep you out of it. Crude oil is behaving. Momentum and path. Ooh, it's the wrong side. You guys remember what I said when you start talking about advantages? I have momentum, I have my path, but my entry isn't perfect. Sometimes people will wait for confirmation bars on those. There's Lonnie's perfect trade. I recognize that one. Momentum, path, mid-band, go, go, go. Great stuff. All right, guys, I'll leave you with crude oil. You don't have momentum because the trigger lines don't match each other. They don't match the background. If you took the odds favorable clear path, doesn't look like it worked. Initial stop probably didn't get hit, started up, lowered risk, and then it looks like it may have gotten you. Guys, I'm going to go stretch my legs for a minute. I feel beat up. That's what happens when the market moves like this. I don't even know what NASDAQ is doing today. I didn't trade this morning. I couldn't get it to slow down enough to trade this morning. And with FOMC this afternoon, I'm probably going to go watch a movie on the couch. Just relax. So I'm going to run a lap real quick, guys. If you have a question, post it in the room. If you have a comment about how much fun you're having today, post it in the room. If there's a concept you want to cover, post it in the room. I'll be back in just a minute, guys. you say? Let's look at it. I'll bring it up. We'll see what it does. You know, I was thinking as I was taking a second. Whoops, look at those triggers. Those are messed up. Let me reload all historical data, see if that helps. That still looks wrong. Something's not right with my gold. I may be the wrong. Are we in 5 now? Oh, we're in June? Shows you how often I go to gold. Let me turn that into June. There we go. Jen, quick question. Every time you turn on Ninja, it immediately shuts off. Literally stays open for 2 seconds. Is it a... Oh my gosh. Jen, that's what Jason is for. Jason is for problems like that when Ninja does that. So typically what it is, Jen, is you've got something corrupt in your workspace, and because it's the workspace that's crashing Ninja, that's also the workspace that opens up default. So it goes right back to that corrupt workspace and kills it instantly. What Jason's going to do for you, but if you're comfortable doing it yourself, either way, I say use Jason. He's brilliant. But if you're like me and you hate waiting, here's the instructions. He's going to have you delete all your old workspaces, templates, and just have you rerun the new ones straight from the resources, or he'll do it for you. Let him do it for you. But for those of you that have ever had this problem, that's typically how you fix it. But remember, guys, Jason is here for you. Jason is here 100% for you. Use that resource. I use that resource. If I get outside of my technical abilities, I go to Jason as well. Or my brother. Everything is up, didn't quite clear it, and just easy money. Wayne, I giggle now because you're like, oh, I cleared it just for Mark. Good looking trade. I mean, there's gold. And look where it started. Does anyone think it's an accident that that huge run up started directly from a termination condition? First, it was just a loss of momentum, and then price reached the divergence low and the trigger stayed above, and it was a termination condition. And then it reversed the market, which was a strong bottom. And they have been gangbusters all the way from that strong bottom. Pretty cool, right? Very basic lessons. Everything says up. Momentum is good. Path is clear. Pulls back to support inside of triggers. And off it goes. And Andy, you're all over the place with your charts. You have the market flow overlay on there. I don't know if that was intentional. I know you're just having fun today. I like that you're able to do that. I like that you're able to say, man, it's wonky. I'll learn some stuff. I'll play around. I'll have a good time. But today's a throwaway. Today is a throwaway. Odds favorable, potential to break. And that's a lot of risk. with divergence. Some of you will have a different plan. Some of you will take it. Just depends on what you want to do. Cav. Like two snakes riding piggyback. Oh, not really. But what you did have is all the momentum in the world, and they bounce right off the fib. So you just ride the momentum. Two snakes riding piggyback, Cav, that's when the large and synthetic are one on top of each other. Literally overlapping, not parallel. Now I have to rethink that analogy or that metaphor, because technically that does look like they're one on top of it. But when I say two snakes riding piggyback, I mean literally one on top of the other, so there's only one retracement zone. This is such a beautiful trade though. Nice job. Does that make sense? This is why I love it when you guys say something and I'm like, oh, that's not what I meant, because to me it makes perfect sense. But you guys might be hearing something different. So they're both wide, synthetic, overlapping. Maybe is the better word. Overlapping, one on top of each other. I'm going to have to lose that two snakes riding piggyback, I suppose. Still a great trade. And the 50-50 worked. And off they go. Oh, look at that. From termination to termination. Yeah, yours had the upper lower bridge deck. From termination to termination, guys. Pretty outstanding, wouldn't you agree? And look at the fight at the key area. This is one of the things that I like. Here's a pretty cool lesson. So gold is screaming north. And as they get to those very key areas up here, the sellers test the water. Or the buyers take a little bit of profit, right? And then they do it again on the way up. And then they do it again on the way up. And then when you actually get to that key Fibonacci area, that's where the big push comes. Guys, this is poke it with a stick, poke it with a stick, poke it with a stick. Hit it with a freaking bat. And you'll see that a lot as you start getting closer to these key areas. But that's kind of neat how you can see the fight. You can see it starting to build. Chili dog fail with a loss of momentum. So you're taking the jump in, and then it gets to the wrong side of the triggers and stops you out. And then you're still on the wrong side of the triggers and you take it again. And that's your HVA line trade. That's using the HVA to help you just go with that strong trending market. I like it. Hey, Cav, thanks for being here today, man. I appreciate you. We'll see you tomorrow. I like that. The chili dog fails. The momentum trade fails. And Wayne says, but we're still a strong trending market. I'll use that statement of this is where all the buyers rallied and where they're most likely to rally again. Great usage of the HVA there. And guys, this middle chart, I don't teach this. This is the market flow chart. It's available to you. It's a great chart. And once you start to see the easy stuff, this is one of those things that you can incorporate into your plan if you want. And Wayne, such good usage. Hit the area, big untradeable bounce. Large triggers didn't follow and they snapped back to it. And they started heading back up. And then they have weak triggers and another big untradeable bounce. And your strong trending market is no longer a strong trending market, ladies and gentlemen. Three divergences, or one divergence, Weak triggers, right at a fib. This is what it looks like when the sellers have a good shot at taking back over. That's what it looks like when a top is put in. Yeah, there's no reason for any more longs, right? And we're not in Shortsville yet because everything is still above those fibs. So if you can't go long per your rules and you can't go short per your rules, what's the third option? Sit on your hands. Go make a sandwich. Play with a dog. Play Scrabble. I play Scrabble. This is my, oh my gosh, my rules aren't met. I go to the MSN casino. Or I go to MSN games. This is my favorite. I play Scrabble, guys. I'll put this on a different chart or a different monitor, and I'll just play Scrabble. Because it doesn't cost me anything to lose at Scrabble. It costs me a lot if I trade in determination conditions. Isn't that awesome? 3 divergences, termination, and look what the market's doing. And guys, this is going to be your line in the sand. Are they going to turn it into a big old trend trade and continue up? Or are they going to break? I don't know. I have no idea. But I can tell you, I prefer not to trade into a mid-band after a big, strong trending market. Because if I had to pick a spot where it's most likely to go back and resume the trend, this is it. You're watching a documentary about the Cold War, Duck and Cover. Oh, right on. I remember that song. So if you're my age, you remember when the Russians were going to bomb us. And that was just a given. And if they dropped a nuclear warhead on your city, you had to get under your desk so you could survive. I think that might have been flawed logic. Maybe it's so they could have the bodies all piled neatly in one spot. I don't know. Yeah, but that was a real thing in the 80s. We were all convinced as kids that the Russians were going to bomb us. Remember that movie, made-for-TV movie, The Day After? I think that's what it was called, The Day After. Scared the hell out of all of us. I remember that. Look at the fight, guys, right at the mid-band, right at the fib. Do you remember that, Trina? I'm fascinated by it. I'm absolutely fascinated by the weaponry. Yeah, I think I did too. I can still see it in my head, the dog, or not the dogs, but the horses in the field turning into skeletons. I have that image burned in my brain. It's interesting. Look at the reaction, guys, right at the mid-band. Yep, I know exactly which one you're talking about. Look at the reaction at the fib. Trina, there's your poking its head through instead of smashing through. We talked about that earlier. I can point it out here. How many pictures, how many lessons could we get in one picture? We could get terminations. We could get weak triggers. We could get strong triggers. Technically, we could get clearing the fib. We could get not a good 50-50. We could get price pulls back to the large triggers. Strong trending market. Wow. That's from one picture. If we took a little time annotating these things, what a database we would have. If only there were some place to put it. Oh, wait. Bum, bum, bum. Guys, if you can't take trades, take pictures. I'm telling you, nobody ever took 50 pictures of strong triggers and said, I wonder if those triggers are strong. Or I wonder if those triggers are weak. Or I wonder if that's a termination condition. Or that's a termination condition. Or I wonder if that only had the potential to break but didn't. Guys, I'm telling you, pictures are where it's at. The more pictures you take, the quicker you're going to get to where you want to be. Any questions on why I won't trade into a mid-band after a strong trending market? And now we have 3 divergences in the same price range, but no rules met yet. Let's see what they do. How about 96.2? I'm going to put a circle on it. 3 divergences, strong tops. That's my brother used to do this. What's it likely to do? Well, it could go, this is the next trouble spot if they start cranking down. We'll see what happens. Crude oil is right at a termination condition. And there's that fight again on the way up to the fib. Test it, test it, test it, test it. And then we'll see if the sellers decide they want to take over. Isn't that neat? Do you guys ever think like that? Am I the only one that thinks like that? Jason fixed it? I know he is. He's awesome. No chili dog from the mid-band. I don't think there was one. You don't have momentum. Yeah, no momentum. You can't have. Well, you do have it on your small chart. You do have it on the small chart. You don't have it on the large chart. And look what happened. Look what happened. Isn't that crazy? How easy is it to avoid losses? Wayne has a very detailed plan. There's no doubt in my mind. Wayne, you've probably written out, studied it, amended it, practiced it, verified it, and you stick to it. Shows in your results. They're fighting right at a key area. The buyers and sellers are fighting right at a key area. I'm still learning too, Wayne. Every day. Every day I'm learning. Every day I'm learning. And I can tell you that what I'm doing now is it's just a trend trade. So John Novak and I are doing a lot of research on different patterns right now. And it's not anything that I'm allowed to share. I've been told don't share what we're doing. But I can tell you that all it is a trend trade. It's odds favorable momentum and a clear path. And there's some nuances in there. But it's odds favorable momentum and a clear path. And I wish that I could just put it on a t-shirt and mail it to you guys. Once you have momentum and path, it's almost like trading becomes effortless. You start committing, and this is, I'll watch you guys do this. Take a trade here and exit here. And then re-enter here and then exit here. And then re-enter here and exit here. And what you're saying when you do this, is I don't want to get caught in the decision-making zone. I'll let them fight it out. I'll let them do what they're going to do. I don't have to be a part of that, guys. I can find a way to make money in between trouble. And once you believe that, once you believe wholeheartedly that the next trade is coming, it's easier to be patient. It really is. crude oil. We knew they were testing the waters. Well, I guess I closed my S&P. What do you want to talk about, guys? I'm rambling. I know I'm rambling. I'm a rambling man. Here, watch this. I'm going to give you some homework. If you're still working through things, I want you to right-click and go to your indicators. And I want you to get rid of the pro trader. I want you to get rid of divergence potential. And I want you to get rid of the pro trader synth. Do it on crude oil. It'll load the fastest. And click apply. Okay. And I want you to see something pretty cool. Nothing but triggers. Nothing but strong triggers. Nothing but weak triggers. And guys, without the benefits of Fibonacci, you can see some consistency here. You can see when not the strongest look, and guys, you'll get to a point where you say, I bet that was a mid-band. I bet that was a fib, or maybe a mid-band right there. And you'll start to recognize how these triggers come through and how, because we focus on momentum first, you can go back and circle tails and say, with all that momentum, even without the fibs, there was a pullback and the market continued down. And there was a pullback and the market continued down. And there was a pullback and the market continued down. And you start to believe that concept. There was a pullback and the market continued up. And when the colors don't match, look at this, green and red, right? Red background, green triggers, green background, red triggers. And you say to yourself, man, this is a transition phase. I can't get my colors to match one another. I can't get that strong trigger look. And what it does is it keeps you out of all the shenanigans and keeps you focused on looking for that best of the best, and there's your tail. And guys, I think that there's so many things that are so much easier than trying to become a trader by taking trades, by taking pictures, and then go back and go to your indicators and add your pro trader back in. And now I've got the very basic fibs, and now I can say, look, support held, and support broke and became resistance. And there was a bounce. And the one-to-ones created a fight, and the one-to-ones created a fight. And guys, you can go through with the simple and start seeing how the reactions work, and then you can go through. And you could add the one that puts the synthetic time frames in there. And you can see how you can take a very basic concept and then you can start to compound and you can start to grow and you can start to say, okay, a little bit of information is good and gives me an edge. But once I put in the big picture, I really start to see how easy it can be to remain patient, how easy it can be to know where trouble may be. And it's just a process, guys. You've got to see it and trust it. See it, practice it, trust it. See it, practice it, and trust it. Hindsight's 20/20. I can see the problem here. I'm not entirely sure, but you're on the wrong side of all the triggers. And then when it all heads down off a mid-band, everything agrees, you're able to make money. How's that for a good lesson? When everything is pointing down, Andy finds a way to make money down. When everything is pointing up, Andy gets shellacked. NASDAQ is slowing down a little bit. That's good. That's good. It is FOMC day. Um, so we'll see. It'll probably ramp up again. I don't even know where it's trading. So they've added some to it today, without a doubt. Um, Great stuff today, guys. I think there's been a lot of good lessons. I think there's been a lot of good conversations. The patterns have worked. Even if they were too fast to trade, the patterns have worked. 3 divergences killed that strong trending market. And they fought, right? They definitely fought. I'll extend the box that I drew 15 minutes ago, and we'll see if they make it. But it's just patterns, is really all it is. And 3 divergences right from the Fibonacci area. All the momentum, potential to break, pulled back to resistance inside of triggers. And that's where we said, with that look, where we would most likely see the market. And guys, there it is. And I don't have a crystal ball, but what I do have is pattern recognition. And you can see the reaction right off of it. There's a reversal bar on the small chart. Does anyone else think that's cool? My brother used to do that, and it used to amaze me. Well, why would he say the market's going to go down there? Everything's green and pointing up. And it was because 3 divergences in the same price range right at a fib, that's where you start to see bigger moves in the opposite direction. And since that was the only thing, that was probably going to be their first stop. And it was. There's a tiny little fight right there. What was Johnny Carson's name when he did the envelope on the head, right? That's it. That's what recognizing patterns does for you. So it gives you that mind reader thing. And I didn't know it was going to happen. Karnak. There you go. The great Karnak. So if you caught a short based on the pattern, you had a great target. You had a great target. If you tried to go short into support with all the triggers above it, you're not surprised that you just got stopped out. You're like, oh, yeah, that's right. If price reaches an area and my triggers remain above, well, that area could stop the market. And sure enough, it did. Pulled right back to those large triggers. Pretty cool, isn't it? I think it's amazing. I really do. I still am just floored at how accurate these fibs are. You just got to learn to use them, right? Could give you the best rifle ever, but if you don't know how to use a rifle, you're just going to shoot yourself in the foot. And now the termination reversed the market. Well, that's a strong bottom. And now my smalls are above the large, but my large aren't wide yet. It's starting to come together. Starting to piece together. There's the fight right at the key area. Did you guys know that would happen? Or at least have the potential? Right at this dumb fib, after all that move down. Look at the fight. All right, guys, I'm out of stuff. Chris Novak's in here. What's up, Chris Novak? He puts together all the amazing stuff on the websites, all that great educational materials. He puts that together, makes it accessible for you guys. Medium probability trend trade. Strong top, odds favorable, potential to break, perfect entry, beautiful target. I love it, Wayne. Perfect. That's all right. You still see it though, right? So in theory, if you can look at a chart where absolutely nothing is moving and you can identify advantages and you know where your entry needs to be, couldn't we suggest that if you were in front of it live, you'd have a better chance of catching it? And that one might have messed with you a little bit. That might not have given you the entry. Because that's all it is. When you learn the patterns, it's like the market slows down. It's the coolest thing ever. It's like the market it's like it pumps the brakes and doesn't seem so fast or so intimidating. And if you know your patterns and the market is still intimidating, you know the market is flying. And that's when it might be a little untradeable. So, great stuff today. I don't even know what time it is. It's about 11:50. Cool. Let's get